I welcome Jeff Maydew, a partner at McDermott, Will & Emery, and my Aon colleague, Doug Brody, Managing Director, Tax Insurance Business Development. Jeff and Doug, I'll leave it to both of you to comment, things like boot purge, traveling debt, deferred transactions. How do you see those issues affecting clients' willingness to go forward with a spin-off, and how can insurance help there?
Ultimately speaking, there's a series of business decisions to be made. And so separating businesses like this, while the tax efficiency is paramount because of the potential cost of a failed spinoff, there's other decisions that need to be made. How much of value of the controlled business can you extract before the spinoff itself? What other types of businesses or assets might you lump into the controlled company that are not core to distributing? Some of the local country planning and other transaction planning that isn't core to the spinoff itself, but it allows businesses to align either by country, region, or business line in order to facilitate the spin. There's a lot of complexity that underlies what I call the last step of the transaction, which is often either the public or at least the top spinoff transaction, the distribution of the stock is controlled. There's a lot underneath that. And I think the areas where I've seen a lot of consternation and headache is in the country by country planning for a multinational spinoff, and how each individual country and transaction kind of builds up to the whole. And then the monetization strategies, whether that's boot purge, meaning that the distributing company extracted value out of the controlled company in one of a variety of ways. And in order for that value extraction to be tax-free, that value has to be jettisoned out of the distributing company, either to its shareholders as a dividend or to its creditors to repay debt. And there are a whole lot of, I wouldn't even call them rules so much as policies, if you will, that the IRS is constantly changing in terms of how much you can extract and what you can do with that money, how much debt you could pay off and what debt, what types of securities in the controlled company can you create and issue to your creditors in exchange for your outstanding debt. These are rules that are very important to the financial impact of the spinoff itself and the ability to have two successful companies at the end of the day. But there are areas for which there's very little clear law, and the guidance that exists changes frequently. And I think where insurance companies can play is the moment that the transaction's taking place, what is the guidance? What is the right answer? And what are they comfortable putting on their balance sheet and taking off the balance sheet of the distributing company in terms of risk transfer? The IRS is saddled with their own ruling policies, their own stated policies, changes in those policies during the course of reviewing a PLR, for example. And just it's much more complex to try to get a ruling on whether it's purging boot differently from the way the IRS anticipated it, or doing a transaction in a local country that might seem unnatural to what we do in the US because local law is different. And I think, insurance, especially when you're talking about non-US, having local country experts dealing with local country insurers to address that risk is going to be much more efficient than having US practitioners dealing with the IRS about local country risk.
Yeah, the monetization especially is an area that's ripe for getting extra comfort. There can be any number of just structural aspects to a company's organizational chart that may make the most tax efficient transaction not easily done in a way that IRS Chief Counsel would bless in a ruling, or that fits straight down the fairway in terms of the guidance that exists today, which, as you correctly noted, Doug, is in a continuous state of flux. And monetization is perhaps the most attractive aspect to a spin. It's when management is thinking about whether to spin or sell, it's the monetization component that leaves distributing with cash, still no tax to pay on exiting this business, and gets you closest to sale treatment without a tax bill attached to it in most cases. And yet to get through those gates to achieve the benefit, you may need to take steps that management isn't willing to take. You may need to make assertions about timing of a boot purge, your distribution to shareholders, that management doesn't want to be tied down to. Or you may need to do some factual diligence that's just not very practical, like computing your basis in internal subs that you've never computed before and goes back 20, 30, 40, 50 years. Just not a very practical exercise, right? Not something people want to do. So you can know that you're, a tax advisor can know that you're pretty safe in terms of the level of risk just based on experience and what the law has been to date, but actually getting a ruling to say that, or in some cases an opinion to say that, can be a different story, notwithstanding the great business motivations behind wanting to implement it.
Yeah, agreed. There is that reputational risk as an advisor when you're issuing an opinion based on a series of assumptions, representations, and frankly, often future events, right? Because a lot of the spinoff treatment is going to be based on actions that may or may not be taken after the spinoff. And so I think you're probably across the board, whether you're talking about accounting firms, law firms, or otherwise, there's this general tendency to hedge your bets and to maybe to not notch your confidence level down a peg because of just the inherent uncertainty of the facts, reps, and actions in a spinoff context. And I think that the insurers largely don't have that reputational risk. They're in the risk game for that matter, not in the risk avoidance game. And so I think insurers just inherently understand the mathematics of the risk that they're taking on and underwriting. Whereas as advisors, you're sort of handcuffed without clear law to cite. You just can't get to the level of comfort that often your taxpayer needs, in order for the public disclosure or to satisfy their board. And so I think that there's another place to play there where it's just a lack of ability for an advisor to confidently state at a will level a certain result, whereas insurers can state, with more certainty that they're willing to take the risk onto their balance sheet.